Hey everyone, it is Jay Soloff from Investors Alley, and this is our options trade of the week. And once again, this is a trade for educational purposes. If you're looking for actual trading recommendations that will be tracked, I have paid services for that. Options Floor Trader Pro is the one linked on this page. But this is just for educational purposes, so you can learn about different ways to analyze and trade options. So speaking of that, we are going to look at an interesting trade today in Micron technology. So I'm here at marketchameleon.com. I'm looking at their unusual options page, which is a good way to see where a lot of the action is. And you can see right off the bat, Cisco Systems used to be one of the most active stocks trading. It's become kind of your sort of tired blue chip these days, although it doesn't mean it doesn't have future potential. But obviously a ton of call action, bullish action today, 96% calls, 6 times the relative volume, 500,000 options. So that's the sort of thing like, oh, I want to I want to see what's going on here. I want to learn more about that. I want to see what's maybe there's some opportunity there. Viacom is one that has got the fallout from the fund blowing up, the Tiger Cub fund blowing up. But we're going to look at Micron, and this one is up 5%, and this one was on earnings. So Micron had really good earnings. They beat earnings. A lot of positive things going on for Micron. You can see 75% of the action was calls, which again is generally bullish. 2.5 times the regular option volume. Again, earnings will generally create more volume, but definitely this was a result of earnings and the good news that they had. So if you want to see what some people were doing, you can go and look at the trades, and I like to sort by quantity, and you can see a whole bunch of call action right at the top. So I was breaking these down, and these were a little bit more complicated, but if you were to break these down, they're basically the same strategy being done at different times. And what this is essentially a call 2x1, and this is more of a professional sort of strategy because it's got some unlimited upside risk. So not generally the sort of thing that you would do in retail, although there are ways to modify it to make it more risk friendly. But what's going on here is it looks like the 110 call. So with the stock at 92, it looks like someone was buying. So let's look at these May trades. So the 110, those were sold, and this one looks like they were sold. And then you look, all these 110s look like they were sold, but it looks like the 95s were purchased here in May. So, and it looks like half the 95s were purchased, half of the 95s compared to the 110s. So it looks like someone's buying the 95 call, selling the 110. Why would you do that? Well, by selling twice of the 110, you are reducing the cost significantly, sometimes even to a credit. Generally not, but sometimes you can even get a credit out of it. But the point here is that you are significantly reducing the cost of the 95 calls, which are expensive, right? They're over $4. So if you want to buy a lot of those and you want to make it less capital constrained, you can sell these multiple of a higher strike. Now, the risk is that if you blow through that strike, you have uncovered upside risk. And that's why this isn't the sort of thing that is generally done by retail traders. Now, these, the people doing this are probably hedging it with stock or something like that. So they're probably not leaving it naked, or they just have a very strong feeling that 110, it's not going to go higher than that by May. So it's an interesting trade. Now, in order to do this for retail, you could just simply turn this thing into a butterfly, which is, would be buying the 95, selling the 110s, and then buying the 125s to cap your risk, or something along those lines. Let's take a look at this here. So here's Micron. You could see big jump today, almost back to its all-time or its 52-week highs. You can see the big gap up here today. And so this trade is suggesting that we're going to go up from 95 all the way up as high as maybe 110. So definitely higher. Probably they're looking for about 100 or higher to make money on this trade. Looking at that here, we can go to May, 50 days away. And you can see here's a bunch of the action in the 95, quite a bit of volume there. The 110s also. So you could see that this was all opening action. There wasn't that much open interest at these strikes. So this would be a ratio. This would be a ratio trade something like this, right, where you're except instead of, so in the case you would be doing this backwards, right, where you're buying, so you're buying the lower strike, you're selling the higher strike, except this would be 95, this would be 110 here. All right, so now you can see it costs about $2.45, so it cuts about $2, $3 off the trade. Now, if you want to protect your upside, you can simply just come here and buy, just 10 of these. Now you have a butterfly and your risk is limited. So, and it would only cost you a little bit more. So that's probably the way I would do it if I was doing a trade like this, which is certainly the sort of thing you can do. It's a debit trade, so you wouldn't need a margin account or anything like that. So it's the sort of thing you can do as a retail trader. Or if you just want something simple, you can just buy the calls, right? You don't have to buy it at 435. You could go up to 100 and buy those. So there's obviously different ways you can do this. If you're interested in that sort of thing, Option Flow Trader Pro, which I mentioned earlier, all we do is buy calls and puts. So simple stuff. You only need basic level 1 permission to get in. So in order to do it with your broker. So if you're interested in that, check it out. Otherwise, I will be back next week with another new trade.